Gwart Show is sponsored by Ellipsis Labs. Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. You may know of Ellipsis Labs by their first product, Phoenix, a fully on-chain order book DEX that's done over $50 billion in unincentivized volume. This is one of the strongest teams I know in crypto. If you're interested in working for a mission-driven company, Ellipsis Labs is hiring engineers who are passionate about crypto and finance to work on Atlas. You can learn more and apply on Ellipsis Labs Twitter, @ellipsis_labs. Don't forget to check out Atlas too, @AtlasXYZ on Twitter.
All right, welcome guys. Max, big announcement. I feel honored to have you as to be the pod where you're announcing this. So let's hear it.
Well, yeah, it's a sad day because I'm taking my talents to Solana. I mean, I guess I would say I did not leave Ethereum. Ethereum left me. They decided that the best way forward for the most decentralized blockchain was to send it all to Base, have all of the transactions going on a centralized server, and then whenever Base does well, they like cheer and have so much fun with it because all of the transactions that used to happen on Ethereum are now happening on a centralized database, which is not very exciting. So part of my thoughts was that maybe one of the last hopes for actually building a truly decentralized global financial system on a real blockchain, not a centralized server, is in Solana land. And I think they have some really talented engineering. They have a very clear vision for what they want to do, which is
NASDAQ on chain,
decentralized NASDAQ. And I'm pretty aligned with that. And, you know, it's unfortunate. I tried my best to do what I could on ETH. I think we had some productive outcomes from it. There's a lot of push recently to raise the gas limit. There's some push for shorter block times, which I think is really good. But ultimately, there's some structural issues with ETH right now. And I think they're too big for any one person to overcome. It's really something that the community itself is going to have to reckon with and what their values are. And I think those values are not leading them in the right direction for the long-term health of ETH. And so we'll see. I really hope they can kind of get their act together because I want to see great competition between Solana and Ethereum. And I think that's the thing that will produce the most probability of success in our joint venture, which is putting the banks out of business, you know.
How representative of you leaving do you think is, how much does this represent like the deep structural issues in Ethereum? And, you know, you kind of came out of the woodwork, I would say 6 months ago and made a name for yourself, pushing some seemingly radical ideas at the time. And now you're leaving, like straight up. And I'm curious if you think that, I don't know, if we see more defection or if we can glean anything from this, right? Like, you know, you tried, failed. Like, do you think that this will sort of push people to think longer and harder about the direction of Ethereum? Or do you think that two head in the sand to this day?
I think the smartest people who have already been on the line, who have been thinking about these things and think from first principles, are going to see this as a pretty bad sign. I think there's a lot of people with their head in the sand, and I think that's the majority of the problem. So we'll see what the reaction is like, and I guess we're announcing on Monday, which is, you know, the pod will be out after that. So we'll see what the reaction is like. But I would guess that there are a lot of people who are going to see this as a pretty bad sign for ETH core dev health, and there are other people who are going to say this is a good thing. The op is gone. The opposition is gone.
So you were like working on Ethereum research for a little while prior to starting Ellipsis, and you went straight to Solana. Did you see some of these problems initially with Ethereum in your view, or was this functionally, you know, a limit order book on chain was never going to be something that Ethereum was going to be able to provide, so that's why you went to direct Solana? Or did you have some of the similar reservations at the beginning?
Certainly in the beginning, not at all. We put Phoenix on Solana because it was really the only place we could do it. I would argue that, you know, none of the, maybe Aptos and Sui would work today. None of the layer 2s today would support something like Phoenix, where, you know, Phoenix itself often goes to tens or maybe hundreds of transactions per second, and for market makers to have viable strategies, the cost to place those transactions needs to be well under 1 cent. So even with this layer 2 scaling roadmap and what we see in production today, where none of the fraud proofs really work, none of the ZK proofs really work, the cost is still significantly higher and the throughput is still significantly lower than what we see on Solana mainnet. I think in general, when you see ambitious young talent leaving, it's a pretty bad sign. One thing I learned in the tech world is you kind of just want to go to where the ambitious young talent is going, and so losing that from Ethereum to Solana, I think is pretty hard to paint it as anything other than a loss for Ethereum and a win for Solana. I think the best that Ethereum could do from this is, really look in the mirror and figure out, okay, what can we do to be more attractive to people like Max in the future? Or maybe first start with, do we want, young, ambitious wrecking balls coming in? And it's possible the answer is no, but I would say all of this blockchain stuff is still very much in its infancy. And, attracting talent to get us from there to where we want to be, whether it's 1 year from now, 5 years from now, or decades from now, that's still like a extremely important problem. I think it's even more important in crypto, where the general level of the talent pool is so low.
Yeah, Max, you were very critical of the L2 roadmap. Do you think that there has been any shift in the thinking thus far because of what you've said? I mean, I think you've been very vocal, made some almost just objectively true points, right? Like the value is, at least for the time being, is in the execution, and you tried to bring that back, and there didn't seem to be much of a desire to do so. Has any of this shifted? And I mean, now we're seeing base rollups. None of us know if those work. Do you have any inclination as to whether like the time you spent had any impact in pushing the execution aspect?
I think the idea that the execution should happen on the L1 is still pretty dead in Ethereum, but there is now a renewed focus on scaling the L1. And we see that with Justin's Beam Chain proposal. We see that with Dankrad posting about raising the gas limit. I would say it's been positive in that we have broken open the Overton window and there has been a renewed focus on the L1. But I think the idea, which I think is incredibly toxic, that all of the activity on Ethereum should be happening on Base, is still pervasive in the system. And it's like really not aligned with what Ethereum was supposed to be at the start. And I think people are going to realize in 2 years that when 90% of transactions are on Base, it's not a good outcome for what Ethereum was trying to do.
Why do you think the EF doesn't see this? Like, why do they not see the continued domination in L2 market share Base, and they just look the other way? I mean, is it just because it's ETH is money, it's exporting the money? Like, is it just a net positive for the notion that the settlement layer is Ethereum? Well,
I think if you asked, let's just think of a thought experiment. We give a survey to the people at the EF and ask them what the market shares are of the various L2s. Do you think any of them could accurately describe this? I mean, I think there's some great people at the EF who are checked into this and do see the problem. I was talking to a few of them yesterday about this, but I think if you actually broadly surveyed the EF and the core devs, especially, I think the core devs are even bigger problem than the EF in terms of a cultural problem. But if you surveyed them and asked them what the market share was, they wouldn't be able to accurately tell you that.
Well, they can't even, most of them can't even articulate like that they've spoken to application developers when they're pushing some of these.
Well, it's not even, I was on ACD on Thursday, and it's not even the problem that they're not speaking with application developers. They're not even talking to the rollups, and the rollups wanted to change EIP 7762 that I proposed, which would help with the blob fee market, make it a little bit more regular. And they like haven't even spoken to the rollup teams in a year because they're so like insular in their thinking, and they think of the chain as the chain and not the chain as something that people use. And I think if you talk to users, any advice from like some Silicon Valley VC from 2005 is going to tell you like, hey, talk to your users, iterate quickly, improve the product based on the feedback. And I think that cycle has not existed for some time in Ethereum and needs to come back. And it's just something you need to do when you build something that's useful, is talk to the people who you want to use it.
Yeah. Okay. Let's talk then about your goals with Solana. First of all, I don't think you've actually said what you're doing. So like you're going to Anza.
Yeah.
And what is your role?
Yeah, so I'm joining Anza. My role will be lead economist, and maybe it's useful to just talk about. Okay.
Max Resnick, comma, lead economist. Go on.
Yeah, special mechanism designer at Anza. Anyway, so I think a lot of people don't know what Anza is because they're like quietly improving the chain. It's a bunch of really talented developers. They developed the Agave client, which is one of the 2 clients on Solana, the other one being FireDancer. And it's a lot of the developers from the initial labs that moved over to Anza in recent change in the structure there. So just having all of the developers at Anza means that we can focus on building the chain, increasing bandwidth, reducing latency. And I think it's a really exciting opportunity. A lot of the developers there are really talented. Andrew, Trent, a bunch of people that I have not met yet, but I'm excited to meet. And so I think it's a really exciting opportunity. And there's definitely a lot of work to do on the fee markets. And that'll be one of my first priorities. And then moving forward, I think there's work to do on Conensensys. There's work to do almost everywhere in the stack. And the good thing about Solana is that they're always looking to improve. There's never a complacency aspect. Whereas if you look at Ethereum, it's kind of like, oh, we shipped the merge, like we're done. We built the perfect chain. It's clearly nowhere near that. I think in Solana land, at least right now, it doesn't feel like anybody's getting complacent. I think they're pushing all the time for higher performance.
Accelerationists. Like you can tell. I mean, totally, I think is a great beacon of hope in that regard. Like I think he pushes that notion, and sometimes I wonder like if he goes a little bit overboard and just everything is net positive. It's you can see like a very distinct difference in the leadership between Ethereum and Solana. Like it's very evident, and like it's even I don't know how practically true this stuff is, but the idea that Sol should be the 100th most valuable asset on Solana. Like maybe that doesn't work from a economic security perspective, but the idea of like we are maximizing for applications here, like that seems encouraging. I mean, has that generally been your perspective, Eugene?
Yeah, I mean, I think the Solana core team and the Solana community in general, certainly since we started working on Solana, which was in September of 2022, has sort of always viewed itself as this underdog. Clearly not a number 1 in any category. Through most of the time we've been working on Solana, and I think that's been extremely beneficial. Where there's no sense of complacency, there's no sense of the job is done or almost done. There's no sense of victory is preordained. Yeah. And I think the road is still very long ahead for all of this crypto blockchain stuff. There's a lot that's still to be done. I think accepting that and embracing that has been super good for Solana. And, the Solana folks, a lot of that early team does come from Silicon Valley. And so we see some of those cultural aspects brought over to Solana. Things like, what is the point of infrastructure existing? Is it to, create some coin that we're going to call money? That's not really Solana's perspective. The Solana perspective is more that infra exists to serve applications. And then you also see this trickling down to applications on Solana, where most of the teams view their applications as things that ought to serve users, and therefore, the application teams talk to the users. The infra team, I mean, as an application team on Solana, do we wish the Solana team talked to us a little bit more? Of course, but we definitely, have access to them. We talk to the core devs pretty frequently, and maybe more importantly, they're like interested to hear what we have to say, which is not always what I've heard from other application teams building on other blockchains.
Yeah. Okay. So we can't skip over the fact that you are launching an L2 on Ethereum. I don't know what the terminology you guys like to use apart from, what is it? Single purpose blockchain. So it's kind of interesting. We got Max here shifting over to Anza, and you have now launched is it a roll up or no?
It's a layer 2, not a roll up.
Okay. Layer 2. So, what was the motivation there? We've kind of talked about this, but not too much. I know you've done one episode on Atlas, but yeah, if you want to explain like what your rationale there is, having come from Solana and now shifting to a layer 2.
Yeah. So Atlas is what we view as the blockchain for verifiable finance. Verifiable finance is our perspective on what the end game looks like, where there's a lot of great properties we get from building on top of decentralized technology, decentralized infrastructure, such as censorship resistance. And it turns out with this layer 2 architecture, we can get some of these properties while maintaining as much efficiency as possible. I wouldn't say that the layer 2s that are live in production today, which is much more than we can say, have necessarily delivered on this yet. And our perspective is still that, hey, the infrastructure needs to serve the applications. We're application developers primarily. If I had my way, we would just be, building the next version of Phoenix, building more financial products that we think ought to exist. But there are just like parts of the infrastructure that are not as set up as we think they need to be for us to build products that are really competitive with something like Coinbase or Binance, where they have a huge infrastructure advantage because they're completely centralized. They run on top of AWS. Turns out AWS is a much better piece of infrastructure to build on top of than Ethereum or even Solana. So for us, building Atlas, the primary goal is to dramatically reduce jitter, to have a lot more opinionated decisions around sequencing. And these are sort of things that a layer 1 can't really do when a layer 1 needs to remain as neutral as possible. We're kind of going all the way to the other end of the spectrum where we're saying, hey, Atlas is not for everyone. Atlas is not for every application under the sun. Atlas is for a very specific set of financial applications that we think belong on chain, that we think benefit from this specific type of architecture, this specific type of sequencing rules. Not every application belongs on Atlas, and that's totally fine with us. And we're going to build the infrastructure and the applications together, both the applications that we build and applications that third-party developers build. And we're going to, build the infra specifically to serve these applications.
Yeah. Go ahead, Max.
You mentioned jitter. Do you want to just define that for the audience?
Yeah, jitter is basically the variance or uncertainty in latency. So you can imagine a system where if I send a request to the server, it comes back in exactly 100 milliseconds every time. That's 100 milliseconds latency, 0 jitter. You can also imagine a world where my request comes back, or the response comes back from the server with a mean of 100 milliseconds, but very, very high variance. So when it comes to, and that's a high jitter system. And so when it comes to blockchains, especially layer 1 blockchains where you have a distributed validator set, oftentimes the leader is rotating fairly quickly. And then you also have these, fee market implementations that deviate from first in, first out, because you want them to be incentive compatible or revenue maximizing for the proposer or the validator. You end up with environments that are not super good for liquidity providers, such as, hey, I sent my order, maybe Max sent his order 1 millisecond after I sent mine, but his ends up landing first. That type of uncertainty turns out to be relatively bad for market makers. And if it's bad for market makers, it means the quality of liquidity is going to be worse. And so when we come at things from the perspective of we want the liquidity to be as good as possible on chain, we really need to optimize for the market maker welfare, because that is what ends up maximizing the end user welfare.
Thanks for listening to The Gwart Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Okay, so we've seen a lot of the problems, or at least Max can speak to this, but some of the perceived issues with the rollup-centric roadmap. How do you grapple with those now? Like, you've now observed for a year or two, you see liquidity fragmentation, you see, sort of mercenary farmers. Like, it's just like, how are you thinking about that in terms of, okay, like, we're not like, how do you differentiate yourself? I mean, obviously, ideally the best order book, but how do you grapple with some of the roll-up centric problems now in your mind? Do you have thoughts on this?
I'm just not too worried about the roll-up centric roadmap. I think that's much more of a problem for Ethereum than a problem for us. Where for Ethereum, there's this $400 billion asset that needs to get defended. I was going to say we're fortunate to not have the problem, but maybe it would be better if we had a $400 billion asset. But for us as a company, and for Atlas as a blockchain, and for Phoenix as a product, the most important thing is to build applications that are actually good. And like, I think we can all be honest here. If you go use any of the truly on-chain applications, they suck. They suck compared to their centralized counterparts. I would put Phoenix in this category as well. It's, we often talk about it as a very shitty version of Coinbase that happens to be on the blockchain, and that's what it is. It's like more expensive. The liquidity is worse than Coinbase, and the goal is to build products that are actually better, right? And that's where I think you're going to have a chance to see mass adoption. Actually, I think this is where stablecoins really shine today. Talk about Base. I think like one actually super good use case for Base today is, you're very connected to Coinbase. And that means you have this like stablecoin infrastructure that is much smoother than many other ways to send dollars around or to send value around, regardless of what that means for Ethereum, the asset. And so we're just very focused on the product and how do we make the best product for users. And for us, that means, hey, we have to start from the application layer, and that informs the decisions we're going to make at the infrastructure layer. And, putting those two together, I think there's a lot of different approaches. Hyperliquid is another, I think, very reasonable approach where, you build the L1 and the application together. For us, we're building, the layer 2 and the application together. But my goal is for no end user to ever know about Atlas. They should only know about the products that are on top of it, because users don't care about the blockchain, right? Or certainly the 8 billion future users of the blockchain, they're not going to care about the blockchain in the same way that most of us don't really care about whether an application lives on AWS or if it lives on GCP or some other cloud provider. The infrastructure is almost irrelevant here. And it just needs to serve the application. And, as a team that's, built applications, we use applications on the blockchain all the time, both like individually as well as systematically as a company. We have a pretty good sense for what needs to exist for this very specific type of application to thrive.
Do you think Solana ends up with layer 2s? You can go wherever you want with that direction, with that question, but.
Yeah, I guess just to follow up on Eugene's point, I think it's a very good point, which is that I've often criticized the L2 roadmap, but that does not mean I think L2s are bad for crypto adoption or bad technically. I think the criticism I had was a very surgical criticism of L2s being bad for Ethereum, and particularly Ethereum, the asset, because it was a direct erosion of the network effects that they had built up in execution on the Ethereum blockchain. And I think that was my criticism. It wasn't necessarily to say that L2s are a bad technology. And it may be the case that all of the stuff we built in crypto, the best thing was just having a VM and putting it on a database and having everybody be able to access it. And then these centralized servers that are doing verifiable finance are going to be fine. That might be the case. I'm hoping that it will be the case that we can build decentralized financial systems with low latency, low jitter, good market structure, so that applications like a Phoenix can provide exactly what Eugene wants to provide. Right now, that's not the case on any blockchain, including Solana. And I think everybody is aware of that, and we're going to try and fix it. And I would say the other point is that it's really important to build these systems with the whole stack in mind. I think we had this idea that, for example, MEV would be taken care of by the apps. If the apps just woke up and realized that MEV existed, they would rewrite their contracts in such a way that there wouldn't be MEV. And I think we know now, based on the maturity of the research, that this is not the case. There is actually no possible app that you could build that has sufficient MEV reduction that it would provide as good a market structure as what happens on Binance or Coinbase right now. And that is something that implies we need to change the blockchain architecture to fix that problem.
Yeah, I was just going to ask, or maybe give a counterpoint to you saying that there was an erosion of sort of the value proposition of Ethereum as a result of pushing on the execution of these L2s. What makes you think that was really defensible? In the sense, we see users moving to Solana because of lower fees. See, a lot of my theory is predicated on the idea that last bull market, there was a lot of lessons learned that weren't really functionally true. For example, people were paying $100 to swap on Uniswap, right? And I think that a large number of Ethereans took that to mean this is the most decentralized, incredibly neutral chain. That's why people will pay $100 to swap on Uniswap. The reason that people were paying $100 to swap on Uniswap is because they thought that $1,000 that they invested was going to go to $50,000. It wasn't because it was the most credibly neutral and decentralized chain. Solana, in my opinion, and I think you brought this up, and I think you are spot on, and I think it's a very important point to hit on. Solana is the first real competition. And if you don't agree with that, if you don't agree, like if you think that EOS was an ETH killer that never made it, then the conversation is not worth having, right? And I think there's a lot of Ethereans who believe that, oh, we've killed all the ETH killers. There's never been competition like Solana, I don't think.
And to like put a point on that, it's like not the fact that Solana is technically superior than ETH, which it is. It is the fact that Solana now has a soul, no pun intended, but basically there are now meme coins launching on Solana because that is the place where everybody has decided is the shelling point for meme coins to launch. And that is why people would be willing to pay $100 to swap on Solana. Luckily, they don't have to pay $100, but they would be willing to pay it because that's where pumped up fun is. That's where all of the activity is. And that is like the sign that Solana is a real competitor, because there's plenty of other blockchains with far superior tech to ETH as well, like Sui, that I don't think you would right now classify as a credible competitor because they don't have that kind of organic activity going on their chain yet. And when they do, it will be a bad sign for ETH and for Solana, I think, because it will mean that there's more players in the ring.
What do you intend to do in terms of MEV research on Solana? Like, there's some, Eugene, you can opine here too, obviously. You're in the weeds. What are we seeing? Like some crazy sandwiching solutions, intractable problems?
I'm not sure they're intractable. I think they're definitely hairy. So there's this thing going on right now. I guess we should call it like Jared from Subway from hell. He's like the older brother of Jared from Subway. He's making millions of dollars a day sandwiching users. And I think there's still some unanswered questions around how he's getting access to these transactions. What we do know is that somehow transactions which are supposed to be privately submitted to leaders are being leaked into some kind of private mempool. And this sandwicher is picking them up and putting in atomic sandwich bundles into Jitter and sandwiching the users. And I think the first reaction that you might have, this is maybe a Yuri reaction, is like, why doesn't Jitter just stop accepting sandwich bundles? I think it's actually quite hard to have a generalized system and then play the cat and mouse game of trying to identify all the sandwiches.
And they tried for quite some time, and they're a very competent team. And, they decided it was just, not worth playing that game.
There's always another obfuscation that you can do as the attacker here. And so I think that was never really a viable solution. And so the next viable solution was to shut off the public mempool. So for a while, there was a public mempool that Jitter maintained. Yeah. And then when was it, in March or so? March, yeah. They shut off that mempool. And then the sandwiching was way down for a while. But since then, we've seen the rise of these private mempool services, which are the sandwichers either has a direct relationship or is maintaining them himself, and is...
When you say direct relationship with Telegram bots?
I guess like he has a direct relationship with the validators. Transactions get sent to the validators, and instead of going straight to the scheduler and getting sequenced, they're getting sent to another mempool, which is where the sandwich bots are looking, and the sandwich bots are pulling transactions out and then submitting sandwich bundles. So I mean, there's also, we can also get into the fact that we believe that the sandwicher is running a very large private transaction submission.
Yeah. What does that mean? Can you explain that?
On Solana, for a while, it was so hard to land transactions that there was a rise in these transaction submission services. And those help manage the pathway from you submitting the transaction to it actually getting executed on chain. And so we believe now that there is a transaction submission service Nextblock, which is somehow related to this sandwiching activity. The reason we believe that is because there's no sandwiching on Nextblock. So it could be, that Nextblock is just so good at identifying the sandwichers that they never send it to any sandwicher and never leak it. Or it could be that they are so good at identifying them because they are the sandwicher and they told their bot to look away on the Nextblock transactions. So it's a kind of combination of they have a lot of stake now. They have, the biggest sandwich bot, they don't have to pay. Like if you look at on ETH, Jared from Subway submits a bundle, he has to pay like 99% of the profit. This sandwicher is the only one seeing the transaction. He doesn't have to pay anything in his Jito tip. So he's making almost like 100% profit on each of these sandwiches, which is why his profit is so high. And then he's using it to build, these order flow systems with NextBlock. So I think there's a lot to try and track down there.
Yeah, I think it's highly problematic for Solana today. It does feel like a tractable problem, Harry, as you said. It seems like there are like a bunch of issues here. One of them is, you can start with the public mempool, which never existed on Solana until third party came around and built one. Which in theory we talk about bundles being good and public mempool being good for both censorship resistance and the backrunning potential. But it turns out there's like a ton of profit, a ton of opportunity in front running. And then, once that get cuts off, there's this massive incentive to vertically integrate, which we're seeing today play out in this like very aggressive and very opaque way. I think a lot of the numbers that Max cites are, they're pretty hard to calculate. It requires people with a lot of context on what is happening on the blockchain to even know where to start looking. I'm pretty optimistic about this kind of getting resolved in the not too distant future. I think there's a lot of strong teams who are incentivized to get this right on the infra side, which is, like Anza and Jito and some of the other infra teams as well. And there's also a ton we can do at the application layer. I think the fundamental problem here is the XY equals K AMM.
Yeah.
It's a source of a lot of problems, but specifically with this two-sided automatically replenishing liquidity means that these atomic sandwiches are profitable in the first place. Not to say that if you put in a sandwich resistant AMM, there's no benefit to front running. Certainly, if you control a ton of the stake, most of these things are just going to be unavoidable. But there's a lot of stuff that's upstream from the sandwiching as well. So, we see users aping into shitcoins with very, very high slippage. Those are the transactions that are most likely to get sandwiched or get sandwiched for the most sandwich profit and the most user loss. And actually things like improving jitter for transaction submission should reduce the amount of slippage that users need to place, because the reason users are saying, hey, I'm willing to take like a 99% worse fill is not because they are happy to get a 99% worse fill. What they're really trying to signal is they want to place a market order. They don't want their transaction to fail. They just want it to get in very quickly.
Yeah.
And if it turns out, you don't get in until like 7 blocks later and your slippage tolerance is exceeded, then you have to go back and resubmit it. And you worry that, the price has moved against you. And so all of these like infra things, they kind of play together. And I would say like the state of sandwiching on Solana today is more just a reflection of the fact that there's a ton of work left to do on the infra layer, a ton of work left to do on the application layer to make these systems actually good, actually better than what we see in tradfi. Because right now I think it's really, really difficult to argue that the markets that we have on chain are, higher integrity or better for retail than something like Robinhood or something like Coinbase.
I think that's like objectively true, but can I just say something? Like, is it that big of a deal if someone gets sandwiched like on Hawk to a coin if it's like 5%? Like these aren't real assets. Like what is the long run? Like, is it just the vertical integration aspect of like the centralizing forces? I mean, I just don't know that. I'm curious if there's like some threshold, because it's almost like rake. It's almost like, and if you pay a reasonable rake, right? To me, I'm like, okay, like I'll get on a Telegram bot and like if I get filled like 9% slippage, okay, whatever. I'm hoping this thing 100x's. Like,
I guess I would just say the system with the highest rake is unlikely to win. And we saw this, with, shitcoining on Ethereum mainnet, where, it turns out like $100 to do a Uniswap trade is not very competitive. And if the rake on Solana shitcoins is, a few mil to Pump.fun, a few mil to Solana, a few mil to the sandwichers every day, then some other system might come along that is less extractive. Maybe it's more centralized too. And in the medium to long run, people will prefer to do their shitcoining activity there.
I think it's really about how many times the dollar goes around in the system. And if the rake is 1% or 5% in your example, then the number of times that dollar changes hands in the system is going to be lower. And that means from the perspective of the chain, there is less opportunity to capture value. From the perspective of the app, there's less opportunity to capture value.
It's like slowly coming off the table.
I mean, yeah, like it's like, would you rather play a game where if you have, 1% edge in a poker game and the rake is 2%, you're not going to play that game. And I think people probably overestimate how much edge they have by a large margin. But at a certain point, if the rake is 10%, they don't think they have 10% edge in shitcoin trading. So for a longevity point of view, I would say you want as low rake as possible. And then from a perspective of, hey, how do we get to the next stage, which is like decentralized NASDAQ? These are all just dog fooding the chain, like all of this meme coin activity. And it's a great opportunity to see how the chain performs under load, under economic load.
Stress testing
and
for the future of finance.
We can't put like Eurodollar spot on chain if there's going to be some sandwicher every time like Bank of England tries to get out of sterling. Like we can't do that. So we need to address these now.
From your perspective, now going to Solana, do you think Solana has more of, having observed Ethereum now, do you think Solana has more of an understanding of how sort of pernicious the effects of MEV can be? And do you think that, going back to the early Flashbots days, did they kind of ultrasound money aspect of it? Do you think that Solana has taken this into account and said, okay, yeah, this is very bad, and maybe Ethereum went the wrong direction?
Well, I think the real reason that they have done that is because they have a better understanding of what trading is actually like. And so a lot of
it's like a real actual traders or like jumping Citadel like guys.
Former traders who were in the trenches in these firms, and they know what they're doing. They know what the spread means and why the spread exists. They know that it's bad for users, and they understand that any rake that's being taken by anybody is going to increase the spread. And I think it's more of a cultural thing of like just such a high percentage of people have a background of trading that they intrinsically understand. And if you're just like even if you're just a random like mechanism designer and you go through school and you have like the formal training, you don't necessarily understand intuitively that this MEV stuff is quite bad for the system. It isn't necessarily an intuitive result. It's just something you have to see from grinding it out or playing the game and seeing what's going on.
Let's move on to our holiday special, which is cooked or not cooked narratives. We got a long list of narratives, and you're going to tell me if they're cooked or not cooked. First up, intense.
Cooked. So cooked.
Cooked.
Okay. Tell me why.
I mean, at a certain point, we have how many panels about intense and like no real activity on intense happening on chain. I would say a transaction and an intent are not very different things. It was an attempt for some people to build two-sided marketplaces that supplanted existing two-sided marketplaces by like enshrining a new standard. I would say they seem pretty cooked. The one good thing is this gas abstraction stuff where the user can not have to pay their own gas. I think that's really good for onboarding in particular. And we'll see if that happens. That was kind of the original idea of some of this account abstraction stuff. But then they've become these like intent solvers and all this stuff. And I would say it seems pretty cooked to me, partly because there's just so many like vaporware teams building in intent space. And there's like a few good teams that are building real products, and they're just like providing a service, and they would prefer not to call themselves intent marketplaces because there's all these other vaporware teams that are calling themselves intent marketplaces that don't have any traction. And so they get lumped in.
I think limit orders make a lot of sense. They make a ton of sense for this cross-chain bridging problem that we see with the layer 2 fragmentation today. I think with intents, especially when people talk about like generalized intents, there's this like instinct in crypto that we've seen for, I'd say like more than 5 years, where there's these like very difficult like NP complete computational or optimization problems that need to happen. Like, how do we build the optimal block? Or like, how do we build the revenue maximizing block given this set of transactions? Or how do we find the best route from A to B? And then there's this instinct to say like, oh, like computing stuff on the blockchain is hard. And so we're going to outsource it to like a group of solvers, we call them. Solvers or fillers. And I think the problem here is that problem needs to be like, if you're going to have people show up and spend their careers trying to solve these problems, the bounty needs to be high enough. And so the more complicated your system is, the higher the bounty needs to be. And I think a lot of the intent-based systems that people are proposing have very, very, very high complexity and very, very low value. And you need to sort of shrink that gap for them to be useful. So that's why limit orders make a ton of sense, because these cross-chain limit orders, it turns out they're very, very easy to solve. And there's a lot of demand, probably hundreds of millions of dollars per day. So clipping a few bits off of that, it's a decent enough business. But yeah, some of the more generalized stuff I think is just totally cooked.
Yeah, there's like two types of people who are interested, and then a third very small group. The two types of people are people who who overestimate the rent available from this thing and want to build like a solver place where they can shave a few bips off, but don't realize that there will be so little value flowing through. And then there's like academic type people who get really nerd sniped by the problem statement and think that it's a good place to apply like whatever their background of expertise is. And then the third type of people are like pragmatic business people, who are the type of people who no longer go around advertising their businesses as intent-based protocols, because they're just businesses that are providing a service, which is something like cross-chain swaps or bridging.
That was my next cooked or not cooked. What is the state of cross-chain interoperability in general? If you're zooming out, I mean, you're leaving the ecosystem that is building generally in that direction. What are you seeing in interop? Like, I feel like you talk to some people and they say these are close to intractable problems. Like these roll up aggregation layers. Well, it'll never. You may have different thoughts, but it may never work. Like you talk to Doug, he thinks it's a complex charade. What are your thoughts?
Well, there's like one side of it, which is like the Wintermute fills you on both chains. That seems not cooked. Then there's like the one that is seems like one of the really hard problems of the millennial problems of crypto, which is how do you have trustless bridging that's built into the technology? And my perspective was you could just make ETH fast enough and make proving fast enough that the ZK rollups could prove their state transition, and then within at least 1 or 2 blocks you would have your money from ZK Arbitrum to ZK Optimism. But I think we're like really far away from that. There's some teams building on it, but it looks like a really hard problem.
I think bridging seems not that bad today. I think like 95% of the time it's totally fine. And then that 5% of the time you see like massive slippage because there's a lot of demand to go one way, and getting out through the native bridge takes too long, and the liquidity providers can't even do it. I think like interop is just also is people love to talk about how do we solve interop, and no one really asks if it's a problem. And I don't think it's clear that it's a problem. Even on like single blockchains, people like to talk about composability and what are the actual uses for like composability. Like we just don't really see very much, besides people want to compose with an asset. And so if that's all you care about, then maybe bridging the asset is all that really matters. And this whole like cross-chain interop, I want to atomically do some action on chain A with an action on chain B. Maybe there's actually no use case here. So I'm just less convinced that there's a problem here at all.
I think the biggest use case was like atomic arbitrage. And there's like a bunch of people who got into MEV, made a bit of money when it was super easy. Then their alpha decayed, and then like they decided like, what do I do next? And so they started a blockchain company. And those are like people who are longing for the glory days of MEV interop, and those are the people who thought that cross-chain interop
like who?
Would be.
Can you name names?
Should I? I think you guys should beep them out. Can you beep them out? No, I'm just kidding.
Whatever you want to say. I mean, this is a holiday special.
The holiday special. Okay, we're not going to leave any coal in anybody's stockings this year.
All right, that's fine. All right, well then let me ask you though, like the cultural aspect of this. Like, it seems pretty obvious that Optimism wants to make the super chain the blockchain, it seems like Arbitrum wants to make, what is it, Stylus? Is that what they're...
What's the Elastic chain? Is that one?
Yeah.
Which one is that one?
I don't know. ZK, all the layer 2s are becoming functionally their own layer 1s.
Well,
and
everyone wants all the activity to happen on their own infrastructure.
Yeah.
I think that makes a lot of sense from a business perspective.
100%. So is this, I mean, do you see this trending in the right direction? Especially look at, I mean, you were talking about the dominance of base. Like, is this heading in the right direction?
I think if you look at Optimism in particular, they seem to be very aware that the dominance of base is not a great thing for the superchain vision. So they seem to be taking some actions. Maybe it's too late, but they gave that grant to Kraken to build Ink. I think they seem to realize that a world where 95% of superchain activity is happening on base means that they're not in a great position in terms of pricing power. But I think the real risk is that 95% of all Ethereum activity is happening on base, and then Ethereum itself is not in a great position in terms of pricing power.
Ethereum wants to be in this world where you have a bunch of layer 2s that have, with no one having some dominant market share, and so everyone having to, stay aligned with or continue paying rent to Ethereum to stay in the game. And when one becomes extremely powerful, then they have the ability to have more negotiating power with ETH. And so, yeah, you'll see this with a single layer 2 or within a layer 2 ecosystem. Like if Base is dominating the superchain, Base has a lot of leverage over something like Optimism. And even with applications on these blockchains, we see like, hey, if we have an application that does super well on, some layer 2, we can always go to that team and say like, hey, we're going to go to a different layer 2 unless you pay us off. And so like this dynamic is just like present everywhere. But we see it, we're seeing it a lot in crypto now. And it's, this old like business school concept of you want to commoditize your compliments and, you really don't want to be the commodity because you lose all your pricing power.
Yeah. ZK, cooked or not cooked?
Not cooked, but there is a very, very long way to go.
Yeah, not cooked, but...
What do you think about like the discussions about Solana and ZK?
Yeah, so let's just summarize this, right? The discussion that I think Tolly was having on Twitter was that the reason Ethereum is so excited about ZK is because they've artificially painted themselves into a box with solo stakers. And so for them, in order to get into a place where they can credibly compete with Solana, they need to make their proposers much more sophisticated and make their verifiers... Like the current bottleneck that they have is that the verifiers are all like these shitty like dial-up modem Raspberry Pis in the Sahara Desert. And so they're having this issue and the way to solve that for them is ZK is going to make it so a really beefy proposer can propose a block, prove it in real time, send it out, and all of the shitty Raspberry Pis can verify it. And so that's like really exciting for Ethereum. But since Solana hasn't stepped on that bear trap yet of trying to limit their hardware, it's not as compelling yet. But that doesn't, I would guess that there's some use cases for ZK because it just makes a computation that currently has to happen on N boxes happen on one box. Does seem like there is potential there. I just don't know exactly how it's going to fit into Solana scaling roadmap.
There's this constant that keeps going down in ZK, which is what is the cost to prove versus what is the cost to do the computation. And if that number is like 1 million today, then basically that means the overhead of proving, assuming verifying costs 0, which is, we'll say it's roughly true. It means you need, for it to be economically viable as a system, you need there to be like 1 million verifiers for 1 million verifiers for every prover. And so maybe, as that number gets down to like, 10,000, as the ZK tech gets better, it makes a ton of sense for Ethereum mainnet to adopt this type of technology. And we don't really know what the theoretical limits are here, but let's say in theory, if you get it down to like 2x, then even something like Solana, where you have a few hundred block producers around the world, maybe a few thousand validators following along with the chain, it could make a ton of sense then to ZKify the whole thing. But I would say like all of that tech today is still like very much unproven. And these are like really, really big, complicated, low level, and even like the auditors don't know how to audit these systems, and they're massive. And so like to get to the point where your system that is custodying, hundreds of millions of dollars or billions of dollars to completely depend on this tech without any sort of other, safety gadgets, I think that's just a really, really scary proposition.
How soon do you think we see rollups, or do we ever see rollups move to the stage at which point Vitalik deems them worthy of mention in a blog post?
I think there's this problem where the market does not demand this. We saw like Optimism and Arbitrum being, just live for many years without any sort of proving system. And for better or for worse, the market has said, we don't give a shit. And so then what is the incentive to relinquish your multi-sig? I think in the past, one of the arguments that people would have made would be, hey, there's some, regulatory aspect. Maybe that's still true. I don't know what the next administration's position on rollups is exactly going to be. But like if the market doesn't demand it, it's super unclear to me why teams would like spend a lot of their budget trying to push in that direction.
Yeah, and I think it's even more than just budget. It's like they're not willing to sacrifice any UX for that, because what matters is like better UX than each other, not like better alignment with Vitalik and Vitalik tweeting about them.
It also, nobody ends up going to jail. This is like my crusade is like,
nothing ever happens.
Yeah, that's my new nothing ever happens is nobody goes to jail.
Hopefully our bar is higher than that though.
I would agree. Ideologically, I also look at Hyperliquid. I see Hyperliquid crushing. It's 1 or 2 validators.
I believe it's 4.
Okay, it's 4 validators. They intended to centralize. Like, we can all sit here and agree that Jeff has like crushed it. You know what I mean? Like he's built like a killer product. And like, what happens if they just allow that? Like, what if that's just okay?
That would be like pretty sick for the world if people could build cool shit without having to deal with a ton of regulatory overhead.
Yeah, we think a lot about like, building better financial systems, and you can't do it in this traditional way because the regulatory apparatus gets in the way. That's actually an area where the regulations are somewhat clear, whereas in crypto they're not super clear. But if it becomes okay to, hey, like, experiment and innovate without some of this like decentralization theater, I think you could actually see the pace of innovation in finance, especially, what we're interested in at Ellipsis Labs is a lot of like market microstructure. How do we make like the most liquid markets in the world even more liquid and more efficient? You would see, I think, significantly more innovation there. So
I think that's like not an unlikely outcome. I genuinely believe that it's not an unlikely outcome that like the aggregate positive effects of crypto thus far has just been like giving a place for somebody like you to come and be able to create an exchange. Like you're not going to just come out of college and be able to rip something like that competes with NASDAQ unless it has a Solana like backend and infrastructure. Like that's just not feasible. You would need hundreds of millions, billions of dollars, right? Like maybe that's just like what we've done, right? Like you've said it before, the vampire attack on traditional finance, like pushing the boundaries. And I think that Elijah, your friend, brings up a good point. Well, he says there's like very little innovation in traditional finance. Like there's like entrenched actors. They don't have much incentive to, innovate. And like maybe that allowing you to like create an exchange like this is like, that could be the positive impact. And maybe they just allow this stuff. Like I'm inclined to think they might.
Yeah, I think that'd be a huge win for, global markets, let's say. One thing we like to say is, tens or hundreds of billions of dollars have been put into R&D to get really good at trading these limit order books on, the NASDAQ or the CME. And when you look at the amount of investment putting to making those systems better, it's comparatively so much lower. And, like the talent level at a place like Citadel or HRT or Jane Street is significantly higher than the talent at the NYSE or the NASDAQ or the SEC. And the incentives are totally warped as well. So having a structure in place where, people can show up and try to compete with, these more entrenched actors, whether that's through crypto or not, I think is a huge win for finance.
Like just showing that we can opt out may be enough. Like even if the opting out is less efficient, higher latency, like the ability to opt out pushes the boundaries, I think, with TradFi.
My guess is that we'll have superior technology that will be a better product. I think the optimistic case for crypto is that we're able to solve some of these very challenging problems in distributed systems, making a low latency, high bandwidth, low jitter system with low rents for any individual. And then you build a better liquidity layer. And then I think the first sign that we're winning will be when IPOs start happening on chain, like real IPOs, not launching a vaporware governance token, but like a real IPO happens on chain, because the thing that you are trying to get when you IPO is liquidity. And if you build a better liquidity layer, then IPOs will demand that liquidity. So if you build a better market structure, I think the first movers will be companies that want liquidity, doing real regulated IPOs on chain, because the market structure gives them better liquidity.
What do you think about Tolly's idea of we can actually be faster because we have these distributed boxes around the world that get signals before they travel to New Jersey?
Yeah, I think this is like actually just 100% correct. The thing is, the interesting thing about Tolly is, so I've done a lot of thinking about this problem. Took me a very long time to get to the multi-proposer, multi-leader is the right approach. And like Tolly just like one shot it. Like he was just like, oh, this is probably right. And then didn't think about it too much. But I think he intuitively just like snapped to the right approach, which is kind of crazy because it took us like at least 6 months of writing out math to get there, which is super bullish. I think it's just based on all the math that we've done, it looks correct that the more validators you have around the world, the more information you will have. And critically, maybe the missing piece that Tolly hasn't articulated super well is that it's not necessarily about how much information you get, but it's about how cheaply you get that information. And if you have more validators competing to provide that information in a short time window, then each validator can be paid less because there's competition to provide the information. And that's, I think, the missing piece of the way that Tolly's articulated it so far, which is that you can get information for cheaper, which is really what's important, not necessarily getting it faster, but getting it cheaper.
Yeah, I think getting it cheaper makes a lot of sense. And this really goes hand in hand with your argument about reducing the proposer monopoly, where, no one can extract monopoly rents over, the information propagation. I would push back on the assertion that you can sort of go faster than the speed of light when you have validators around the world. And I think the crux of what is happening here is, you still have this like local view from wherever you are. And kind of the thing that actually matters is not when, one validator has heard about this information, but more about when the blockchain as a whole understands information, or maybe the client on the other side of the blockchain understands the information. And then you really have to be pretty rigorous about whose view you're talking about at any time. I guess I'll also say when I've disagreed with Tolly in the past, I would say probably like 80% of the time or more, he's been right. So I think this is one to think about a little bit more.
Is the ultrasound money meme cooked?
Cooked.
I mean, even they gave it up, right? Like, it's not like Justin Drake is going around tweeting about ultrasound money anymore. Like, it seems pretty cooked. It's just not something you want in an asset for it to be deflationary. Like, it's just actually terrible for a real asset. If you want ETH to be money, it's actually incompatible with the ultrasound deflationary aspect of it, because all of the monetary economic theory says you should have a slight inflation so that people are incentivized to push the money around.
If you want it as a medium of exchange, strictly, I think deflationary aspect is incompatible.
Yeah, I think
depending on how you
store
define
value is a little bit different.
Store value
is not really money, at least not the way we traditionally conceive of money. I mean, I think it was like a valiant attempt where, it's very difficult to justify a $300-400 billion valuation on an asset. And I think if the fundamentals are not going to be there in terms of cash flow, then finding some medics that may be able to justify it, it makes sense to try.
I agree. I defended Bankless for shilling. I mean, I really think that there was such a massive speculative premium that was put on ETH, and then you come to this merge aspect where not only is it trading at $300 or $400 billion, but you've also reduced the cost of computation by 99%. You have to sit there and figure out a way to justify the value of this asset, because God forbid you do it in a DCF model. And So I think it was a valiant effort. But now my question is, what happens in the long run to the value of ETH?
Just to be clear, this is not a question only for ETH. I would say
it was sold. Yeah, exactly.
The vast majority of crypto assets, maybe every single one besides
L1 tokens, I would say.
I would say everything besides Bitcoin and stablecoins kind of has this problem where there is no reasonable world in which the cash flows justify the valuation, and so you need to find some other justification for the valuation.
Yeah, I mean, Bitcoin also has a problem, but it's just like hit escape velocity that
right, exactly.
I think we should like stop worrying about it. But
yeah,
for everything else, they're trying to be both. Like
okay, so then how do you view the long-term valuation of ETH? Like, is it going to trend toward fundamentals? Because that's not good. It's not good for current holders.
My guess is that everything is currently valued based on kind of a naive market onlooker saying,
yes,
one of these things is going to win. So let's just be clear. One of these things is likely, I mean, there's some low probability that this technology is completely cooked. So like, let's say that's maybe 10 or 15% that the technology as a whole is just completely cooked and like we've been wasting all our time. Hopefully that's, God help us if that's true. But the other 80%, 85% of the time, one of these things, whether it exists today or one that comes in the future, is going to win the whole thing, or 90% of it. And it's going to eat the world. It's going to eat finance. It's going to eat NASDAQ. It's going to eat NYSE. And it's going to be worth so much fucking money that like it will blow all of these XRP shillers' minds. Like, but all of these things have some small probability of that, and I think they're valued based on that subjective future probability. When ETH takes actions that make it so it's impossible for it to ever get there, that is when ETH price should go down in this model. And when ETH takes actions that make it seem like it has some higher probability, like when the ETH community starts to wake up and say, hey, we actually need to shorten block times, we need to raise the gas limit, we don't need to ossify just yet, that's when you should see this model, meaning the price of ETH should go up, because the probability in like a prediction market of this thing winning goes up. And so I think that's partly what's going on. And then part of it is just like, people are shilling XRP on TikTok, and, we have no idea what's going on there, but that's part of it too.
I don't think there's much of a coherent valuation methodology getting applied to any of these assets. And I think there's this fundamental thing that's happening, which also happens in pretty much every other market, which is if you have like some sort of cash flow valuation is like a rough lower bound on an asset price. It tells you nothing about upper bound. And I think like it is very difficult to short in general. Shorting crypto, I guess like everyone who's done it has kind of gotten blown out. So there's basically like no downward corrective pressure on asset prices. So it just looks very bubbly. We of course see this in other assets as well, including something like gold, or including something like U.S. equities, especially tech stocks. And maybe they come down, maybe they don't. But the only thing that the DCF analysis will give you is some sort of lower bound.
Yeah,
I think right now there's just so much money chasing so few real companies and technologies in crypto, and more broadly in the US economy and the global economy. And the way to correct that is to build more cool stuff that justifies its valuations. And hopefully we can grow into the amount of money that's been spent on this industry. I think we've probably far overspent for what the technology that's been produced so far is, but the potential is so high that I think people still are excited about it.
Yeah, I mean, this stuff just like almost definitionally has to be less extractive, and being less extractive is not, to me, a compelling investment thesis. I want Apple and Amazon and Tesla to be as extractive as they can. I want them to have defensible moats. I was talking with John Charbonneau earlier about this. I want them to have supply chain agreements with rare earth metal producers, right? This is open source, forkable technology. I mean, there's network effects, sure, but it's very hard to measure that right now. It's kind of interesting. We hear like Kyle Samani say that blockchain should be valued off MEV, right? Like Sol should be valued off its MEV. What do you guys think? I mean, I think he's like, I'll just opine, not that I'm the one who should be answering this, but I think he's like directionally correct. I just think that also almost definitionally must trend towards zero. So it's not like right now, like, okay, Solana's generating a lot of MEV. Like, hopefully this is not the case in the future, or a competitor will come along, extract less MEV, and their token will probably be worth more, even though it's extracting less, right? Like it's just an ongoing commoditization of this. So I don't know how you think about that in terms of like what you were saying. This applies not just to Ethereum, but Solana and every other chain.
So I had a conversation about this with Kyle in Salt Lake a few months ago, and I think his position is like very nuanced and interesting. So let me see if I can share it in the way that he shared it. In math, sometimes we have these results where you have two constants, sometimes in a ratio, and you take the limit as both of them tend to infinity, but keeping their ratio constant. And in this case, I think Kyle's point is, yes, MEV as a percentage of the total activity will go to zero in the limit.
We grow the pie.
But the pie is going to grow.
Yeah.
The economy is going to grow at a faster rate.
Yeah.
And in some ways they're intertwined. The less rake you have, the bigger the pie is. And so his idea is you're going to have so much activity and such a low rake, but the product of those two things is going to be much higher than it is today.
Also, this is, for what it's worth, this is kind of functionally true with what we've seen in traditional markets. It used to be like brokers would charge you 2 or 3% to trade an equity. Right now, you trade for free on Robinhood, but it's in aggregate grown.
But Robinhood is making more money today than they were then.
Exactly.
Than the brokers
so this
were
is
then.
True-ish. One problem that I kind of pushed back on when I talked to Kyle about this, and I don't know that I kind of conveyed this as well as I could, but this feels very centralizing, and this feels like the long run is that Citadel, HRT, and SIG are the three validators. Because if the incentive to validate the chain is MEV, okay, who's the best at extracting MEV? It's HFTs. And so that's one, like, I mean, I don't know if that's even a bad thing, but it does seem like whoever's the best at extracting that very negligible amount of rake is going to end up being the primary stakeholders in the chain. What do you think?
It's like not obvious to me that this dynamic has to play out all the way to the limit. Looking at Ethereum, it kind of turns out that the stakers are not that sensitive to, like 4% yield versus 4.1% yield, but maybe they would be very sensitive to 4% versus 20%. And so then the question is, what is that gap going to look like? Again, going back to Solana, you're some validator thinking about whoring out your stake to the sandwich bots. I imagine the delta they're giving you on your staking rewards is significantly higher than 4% versus 4.1%. And I think those constants matter a lot. So it's more of like, if I don't want to pick on the home staker too much, but is how much better is Citadel going to be than the home staker at like building the block, or the home staker running PBS or whatever gadget we come up with 10 years from now. I think that delta is going to matter a ton.
I think you just want a structure. These people are coming. They're going to operate majority of nodes at some point. Even today on an ETH, maybe I shouldn't say this. I won't say this because I don't want to centralize the supply chain. But there are things you could do if you're a big node provider and partnered with a trading firm that would help you make more money. And they haven't happened yet, but they probably will happen in the future. The goal is to build a system where these sophisticated actors come in, play a game, and the limit of them all best responding to each other in the game is something that has a very good outcome for the users.
Yeah.
Right now, we've designed something that doesn't have that property. We need to design a new thing and change the system so that it has that property. And that's going to be part of what I'm working on for the next couple of years, is trying to do that on Solana. I think we have some primitives that are looking quite promising. The current structure of rotating monopoly on execution is very, very bad for a world where Citadel and Jane Street and Jump and everybody come in, because it's just going to look super, super extractive if that's the case. But you have to make it so that those people come in, they use their sophistication for good, because
they're competing.
But
there is, okay, so this is interesting. Like Bitcoiners would, when they push back on proof of stake, they would talk about this. There's an extreme that you kind of described, and there's actually an extreme, which is that the stake ultimately gets aggregated into 2 or 3 SIG, HRTs, and they just don't let anybody else into the system. Like, that is a possible outcome. And I think that's like sort of a little bit under-discussed in my opinion.
Isn't this what Bitcoin mining looks like?
I mean, you can always permissionlessly join. What I'm saying is you need to purchase stake in theory, in a proof of stake network.
You need to purchase a bunch of mining hardware and get access to a ton of electricity to have any meaningful hash power on the Bitcoin network.
And there's selfish mining on Bitcoin too. We're alienating ourselves with Gwart's audience here.
I think, not really. I mean, well, okay.
Can we do Bitcoin cooked or not?
Yeah, Bitcoin cooked or not? Go run it.
Cooked.
I think Bitcoin's super not cooked.
Yeah.
Oh, really? Interesting. I guess I would say it's probably lindy enough that it's going to make it despite all of the technical flaws with the system. But from a purely technical perspective, it's just basically a meme coin.
I think it is a meme coin, and it's clearly the best meme coin. It's the only meme coin with any sort of real salience, and it's the only one with a defensible position of being the first meme coin. And I think it's clearly crossed the Rubicon.
Yeah, I mean, nation states, we can just be honest about this. Nation states aren't talking about buying ETH right now. They're just not.
No, they're talking about buying Solana. Their new
it's a better
AI
idea.
crypto czar.
The Solana Strategic Reserve.
Yeah.
Yeah. The Paradigm High Watermark Strategic Defense Fund.
Okay, is the meme coin mania cooked or not cooked? How much longer does this persist, I guess, maybe?
Every time I've tried to predict this, I've been wrong. I've always thought that the half-life is significantly shorter than what it's turned out to be.
They do seem to be getting shorter, though. The trends.
So, I mean, one way to I don't know. I thought meme coins on Solana were cooked in April.
They're bigger than ever.
And then if you look at the activity, it's probably 10x today what it was then. I think it's very easy to underestimate, how big something can get and how fat the tails might be.
I think you just have to look at I think you just have to compare it to slots and just see whether pumped up fun is better than slots. And there's an addictive part of this thing that keeps people coming
slots.
back. Permissionless slots. I think it's more connected to the world. What if the slot, you go to the slot and it's some movie from 5 years ago is the slot machine that you're playing or whatever. It's the Wicked slot machine or whatever. It's just not connected with the world in the way that Pumped Up Fun is.
Yeah.
Where Pumped Up Fun is every day you come in it's the Homs shitcoin from the fact that HTS just took Homs or whatever. It's more engaging in that way than But at the end of the day, the two things are okay, there's a huge rent getting extracted every day, bleeding out the money that people are putting in the system, and is the addiction enough to keep the people coming back? Or fun, whatever you want to call it. Addiction or fun, one of those two is keeping people coming back to the system and losing money and expectation.
Depin, cooked or not cooked?
Probably cooked.
Is there anything viable in Depin?
Is Bitcoin Depin?
Sort of.
I mean, Bitcoin's pretty viable.
Okay. Next.
I would say Depin is cooked, not because of the technology, but because any situation where the founder is optimizing for the token price and not the network doing well as a product is just bad. I think we have a very misaligned incentive problem where founders' goal is to gain clout for the project and then launch a token as soon as possible before the clout dissipates. And I think that's very true in Depin, and there's probably real cool things you could do, but the majority of founders in Depin are optimizing for token price, which is the best thing for them to do because
not just in Depin.
Not just in Depin, everywhere, but I think it's particularly true in Depin because it's so the path to we need the token to facilitate the network is so it comes out so
dubious.
soon.
Yeah.
I mean, I think there's a lot of tail wagging the dog in crypto, whereas the token leads the product rather than the product coming first.
Yeah. Okay. Prediction markets.
Cooked for the next 4 years.
You think it's just a political thing?
Yes. I think there's a few things going on with prediction markets. First is you need things that people want to bet on and things that people want to bet on in massive size, which are served pretty well today by existing financial markets.
Yeah.
Even things betting on the election in 2024, the place where you can get the most delta on this is either the S&P 500 or Bitcoin. It's not going to the prediction markets, which I think on their best day on Polymarket did like a few $100 million in volume. That's like chump change. That's like, an hour on Binance. Even, Phoenix trades more than that, plenty of days. And, not just on, special event days.
Yeah.
There's this like thing that the reason like a lot of academics want prediction markets to happen is because prediction markets have this output, which is the fair price. And in theory, people participate in the market to make money from the market and push the market to a more fair price. But like we were talking about before with the solvers, you need enough of an incentive for people to do this. So you need to have like enough non-toxic flow, which is either uninformed bettors or people coming in to hedge. And so in sports markets, we see, hey, there's a lot of people who want to bet. In something like commodities, we have a lot of people who want to hedge. For political prediction markets, I think it's more people wanting to bet, but then there's a ton of interest in the outcome. And then there's an incentive problem where the people who are benefiting from this information, well, the information is a public good. And so who is going to incentivize the liquidity on this prediction market? That answer is like not super clear for the vast majority of things that people want to put on prediction markets. And so I think, today basically what we see is people love to bet on sports. There's a lot of non-toxic flow there, so you can get pretty good prices and outcome. People love to hedge, and I guess also bet on, a lot of instruments we see in the existing financial system. And then these like binary event outcomes, there's just like so many problems with them that make them very unattractive to provide liquidity on, and also not super attractive to bet on.
I think the most exciting things to bet on in prediction markets are these like high suspense, high surprise markets. So what does that mean? Like the stochastic process that governs like how likely one team is to win. So say we're watching like the Super Bowl, for example, the probability of one of the teams winning can change just like that. If somebody missed a field goal, if there's a pass that's completed or not completed, if there's an interception in particular or a turnover, the probability of winning shifts so dramatically. That is really, really bad if you're a market maker, because you're just like caught offside all the time. Yeah. And that means that like these markets are hard to have thick liquidity in. One of the things about the sports market, like you don't see a lot of live liquidity in the sports markets,
and
for
the spreads
this reason.
are so wide.
The spreads are extremely wide, and they are like their courtside with the fastest latency cables, trying to ping faster than some dweeb on like Bet Online or something. Bovada, like definitely.
Yeah. So I think those kinds of markets are really hard to have live real time. Information coming out, and I guess the point that you made, Eugene, which is the real output of prediction markets is the information on how likely the event is to happen. And it's information, so it's not excludable. Even if you tried to exclude it, people could leak the information or whatever. And that just means fundamentally it's a difficult problem to solve, because there is a exhaust from the system, which is information, which is the real value of the system. Yeah. And it's not being captured because it can't be captured.
Okay, we kind of discussed this, but going forward, cooked or not cooked, Hyperliquid?
I think clearly not cooked.
You think Hyperliquid ends up competing with Binance?
That's not what I said. I said not cooked. I think it is probably the project or team or company or product or whatever you want to call it today that has the best chance of competing. I still think the chance is relatively low. But it's one of the only crypto products that people actually want to use.
Yeah. Pumped up on Hyperliquid.
Yeah.
I think we'll see what the flow look like. There was so much uninformed flow just forming the airdrop.
That's why I kind of asked the cooked or not cooked, but yeah, that's what I'm curious, but hard to say.
It might be the goal of these two-sided marketplaces is always to bootstrap a sustainable system. It may be the case that Hype has succeeded in that. It may not be the case. We'll see if the market makers start to get picked off more, if there starts to be less uninformed flow, the spreads start to widen, and then the users want to go away. Or it could be that it's here to stay because they've successfully done that.
I mean, you have this like massive wealth effect from the airdrop. And so one thing that's really important there is the value of the airdrop keeps going up, or the value of the like the problem with any sort of zero sum game, where perps is effectively a zero sum game, is like if your non-toxic flow is losing money and then they either wash out or leave, that's a huge problem for the sustainability of the system. And so you have this way to like inject wealth into the system. You keep the game going on for significantly longer. And so, you know, Hyperliquid, the team or the assistance fund or whatever they call it, you know, slamming in like $50 million into the token and creating billions of dollars of market cap, I think is like an extremely smart move. Where like the multiple you're getting on that capital is just absolutely insane.
Yeah. Max, I'll throw this to you first. Time boost, cooked or not cooked?
I think it's a very bad market structure. I think it's going to be on Arbitrum. I think it's going to be a major reason why Arbitrum fails, because it's like a really bad market structure.
I think we'll just revert it.
You think so?
Yeah.
Didn't you say that Ed was open to the notion of changing it if it didn't go well?
Yeah, they may revert it. I think they like Ed is the type of person who, if you show him the data, it says like this is not working very well, I think he will revert it. The people who are most excited about this are like Arbitrum token holders, because it's going to cause some burning of, or like I guess it's going into ETH that's going to the DAO that's probably going to be used to buy back the token or something like that. Like, so Arbitrum token holders are excited.
Classic flywheel.
And then the traders who are looking at this as an opportunity to establish a moat similar to the builders on the L1 are excited. And that's really a bad sign when the traders are some of the most excited people about it. Yeah, it's the type of person who will look at the data. And I guess the question is, sometimes this stuff is like really messy and it can be hard to quickly evaluate whether a system is working as intended or not, especially when the system is as complicated as this game is. And like, it took a really long time for PBS to show its true colors. At first, it kind of looked like super sick. There was 10 builders. There was tons of stuff going on. There was almost no private order flow for about a year. And then it just started,
devolving.
It
just slowly, everybody stopped paying attention. And like, now there's 2 builders, right?
People care about the start state, and then researchers really like to think about the end state, but the path that it takes to get there, I think there's like, is almost never predetermined. I think with the PBS market in particular, like there are so many unilateral actions that individual players in that ecosystem have taken or could have taken that it dramatically changed the path. And here, I think specifically like Flashbots and SCP, Titan and Wintermute. There's just so many things they could have done to, either get to this state more slowly or end up in a different state. Obviously, a bunch of stuff around private order flow is very, very path dependent. Yeah. Where, the way the market evolved towards these like Telegram apps for trading shitcoins, it was super unclear this was going to be like a big part of the market when the merge happened in summer of 2022.
The Telegram bot stuff, yes. The private order flow stuff, I still stand by. People knew what the end game of this was going to be.
Yeah, the private order flow stuff I think was like quite obvious, but the acceleration I wrote about that in September of 2022, and the way the order flow game is going to play out though I think was not super obvious, where you have these very profit driven, or call them unaligned actors, all of a sudden showing up with huge amounts of valuable order flow. I think that was less surprising. Whereas
MetaMask, for example.
Well, no,
I think it's
it's like Telegram bots displacing MetaMask, right? Where like MetaMask has, 25% of the some much smaller amount of retail share than they did in 2022. And I think it was probably not crazy for one to assume that MetaMask would act in a somewhat aligned way. Whereas, some Telegram trading app, they're just trying to get the transactions in, right?
Yeah, I think the Telegram bots were very much not foreseen, and they did take away a lot of the valuable.
I think they were also unforeseeable
flow, and they were
I agree. I didn't know anything about Telegram bots until really Solana, and that was like, whoa, you can just like send a transaction on Telegram. Like clearly, that's quite different than
But
MetaMask.
The other world was that those users would have still been on MetaMask, and it still would have evolved to the same state. Just like
the end state probably looks somewhat similar, but I think then it depends on the actions of a few key people inside Conensensys.
Futarchy, cooked or not cooked? What do you, Matt, I know Eugene has thoughts on this. Max, what do you think about Futarchy?
I think it's pretty cooked. I think it's more of a meme than like a real system.
Yeah.
It would be pretty cool if it was real. It just doesn't seem like that real. It just seems like there's some very weird things where you're always optimizing for the price or the optimization function, and writing down the right optimization function to like the price of the governance token in the short term is not the real optimization function of any organization, and it shouldn't be. And that's explicitly, even if like we believe all of the math works out and all the system works, like that is what it is optimizing for. And like doing gradient descent on that eventually leads you to a token price of 0, because you end up, just not being able to make any long-term plans, not being able to trust people with high context. And I think it's probably not good in the long run, but it's a cool experiment.
Yeah, I think I mostly agree with that in the long run. Kevin Heavey wrote a very interesting research piece on Umber research about like what Futarchy is good for. And yeah, I think like if you agree that the objective function for this system is to maximize the price of this token, I think Futarchy makes a ton of sense. But yeah, defining that objective function or like coming to some consensus that this is the only thing that we care about is pretty difficult. So I think it's like very interesting to see some of these experiments play out in the wild. I would almost like to see the MetaDAO get like unleashed a little bit more. I think there's like some sort of controls on it today. And I think like, for example, there was this experiment that ran, experiment's not even the right word. Some guy made this proposal, Ben Hawkins from the Solana Foundation, I believe, like 1 year ago, to basically, have the MetaDAO issue him tokens at below or well below market price. And I think like these types of experiments are super good for testing the viability and robustness of some of these mechanisms. That is very difficult to do in an academic setting. And yeah, I think like Futarchy is like very unlikely to be, useful in practice in this like very pure form. But I think if there's even a 1 to 5% chance of it working out in a massive way, it makes a ton of sense to experiment with it. And it seems like really, really unlikely that, the Futarchy experiment runs and fails, and also we learn nothing from it.
The attack surface is just so big, right? Like the number of proposals that you can make are so large that it's hard to think that the markets are efficient enough to survive.
This is also true for like normal token voting governance. Like most of this permissionless governance stuff, honestly, just like seems rather cooked.
Like, remember when Compound wasn't paying attention for like 2 weeks, and the college kids were on break, and somebody came and just rugged the whole thing?
Whose idea was that, by the way? To just like why did whose idea was it to just delegate the authority to like some random college?
It's a charade.
Yeah, well, I think there's a lot of regulatory reasons for some of these VC firms with large bags to not be the ones directly voting.
Yeah, we need like the Cornell blockchain kids to determine the fate of 300 million in TVL. Like, it's just so hard to understand.
Doesn't it seem like there's a really big opportunity for like lobbying these kids, because they're college kids, right? You could presumably like take them to a nice restaurant and they would be like, oh my god.
Yeah, college kids are like the easiest to buy off because they they have such a warped sense of the value of money.
I honestly, man, this is gonna sound like just repulsive, but I honestly wish we had seen more like really, really pure play corruption thus far, because I think it would have accelerated the demise of the governance and DAO charade. Like we saw a little bit with A16Z and Paradigm, like deciding on a bridge for Uniswap. There was some like lobbying of which blockchain club, but like for the most part, people are like too cordial and generally aligned in theory, and we haven't seen like
almost always the consensus process happens behind the scenes,
right? Yeah, and so unfortunately, like we haven't seen how kind of defective a lot of these like governance mechanisms are yet because people aren't doing enough corruption.
Well, we're seeing some of this today with Mango markets. Yeah, where some of there was like a split between the founders, and it appears that one of the sides is effectively trying to loot the DAO and shut it down. And I think it's a very, very valuable, lesson for governance or permissionless governance in general. And I think there's a reason that most of these other DAOs still effectively have like a central cartel that controls a very large portion of the token supply.
Yeah, I guess we did see that with like Aragon as well, which is like there's immense irony in the Aragon DAO like getting all convoluted considering they're supposed to be the ones designing optimal DAOs. Like, dude, what is going on? Like, isn't this you can control your own DAO? How would we expect you to design? But I think DAOs are kind of cooked. Like, I think that's something we can put on the cooked list. And we've also, we've definitely like this bull run thus far compared to last, like how often you're hearing about DAOs. Like, it's got to be many orders of magnitude less.
I think DAOs were like mostly an excuse for tokens.
For sure.
This cycle, most of these teams are no longer feel the need to have an excuse for the token. It's just like, hey, we have the token. There's no revenue share, of course. There's like, but there's like a Discord attached to it, and that's enough. Whereas in the last cycle, there was more of this like deflection theater require this like kabuki of, the token has value because it can be used to govern this thing, whatever that means.
Yeah. Last question, and you can just run with this however you want. You're about to join Anza. What do you want to see in the next 5 years? Like, what do you want to see Solana achieve in the next 5 years? And then you can follow up with what you want to see Solana or Atlas achieve. Like, what, especially now that crime's legal. So make sure to keep that in context. Like, what are we doing? Trump administration.
So in my first 100 days, my goal personally is to familiarize myself with the tech of the blockchain. And so I'm going to do that by attempting to write a Solana spec, which many people have tried and failed to do before. So I expect that I will not be able to write a complete spec, but I will do what I can. So that's my first 100 days. And then I think as part of those 100 days, I really want to focus on getting to 0 slot latency, which means when you send a transaction, it lands in the same slot. Very difficult problem. We'll see if we can get there. In the longer term, over the next few years on Solana, I hope that we can achieve 1 million TPS. I think it's already the place we're at right now is we have closed systems where you can put 1,000 or you can put 1 million synthetic transactions, get them onto the box and get them signatures verified. And the next step is put them in the scheduler and then actually run them and then send them out to the other validators to get validated. So that's progressing nicely. Still a lot of work to go on that, but I hope we can get to 1 million TPS. I hope we can get the blocks times down. My target is 20 milliseconds. We'll see if we can get there. And I hope we can get to multi-proposer. I won't share any more because I think there's...
Well, let me add a little, like, one additional question there. Is Solana going to win now? Now that you don't have to align with Ethereum, you can say whatever. Is Solana going to win?
Yeah, Solana's going to win. Solana's going to flip ETH more than 75% of the time, I would say. Well, if tech matters at all.
It's going to be at like 300 million and 400 million market cap.
If the tech matters at all, it's very clear that Ethereum, just extrapolating the rate of change today and the rate of change of Solana today, there's no competition.
Max is doing the technical analysis.
Yeah, I know, right?
This is the real.
I'm drawing lines
analysis.
on charts right now.
No, I'm not talking about the, you could also do this with the price if you wanted to and draw the line and it would be pretty clear as well. But if the tech matters, which I think it does eventually, it does matter eventually in the long run, then I believe that Solana will flip ETH. I don't know about Bitcoin. I think Bitcoin is like probably pretty untouchable.
Bitcoin's special. You don't have to.
There's like a thing over there. It's I think a Bitcoin price tracker. And it's like running out of digits right now. Like when it's going to be crazy when that thing runs out of digits even more.
Good answer.
For Solana, I think like the roadmap that Max has articulated is is roughly the one I agree with. I think like crypto tech in general has a very, very long way to go, where there's just like a lot of easy wins over the next 3 to 5 years, mostly in, making the blockchain significantly bigger, dramatically increasing the amount of block space to enable like useful things to be done on them. I think like the winning case for crypto like may not actually be the asset prices go up significantly from here. I don't really have a view on that. But I think that, crypto winning doesn't necessarily mean the price is going up for anything besides Bitcoin. It mostly means, using crypto tech, we're able to deliver better outcomes and better products to real people and real businesses, as opposed to, continuing to mostly serve this circular Ponzi game.
The lesson from big tech is that when you actually build something that a lot of people want and build these platforms, there's a lot of money to go around. And whether that ends up in the hands of the token holders or not is still an open question. But it seems to me like there is a world in which you have 1 million TPS, you have each transaction paying like 0.1 cent or 0.2 cents, and then you do have billions of dollars a year in ARR, and that justifies a token price.
Maybe justifies a current token price.
Yeah.
I think 1 million TPS at 0.2 cents a year is something like 60 million ARR or 60 billion ARR, sorry, which would be enough to justify like the ETH token price.
Sure. That's a lot of dollars getting paid into the system. I agree.
That's encouraging. That's inspiring. That's a good place to end.
$60 billion of annual revenue for Solana. Got it.
Yeah.
Gotta make it happen.
That'd be great. Yeah.
That's on the roadmap.
All right. Thanks, guys.